In this Track and Trade 5.0 Futures Trading Training video, I want to start by demonstrating for you a simple narrow channel trading example. Now we're looking at the current cotton contract, and you can see that it's gone into a real nice long narrow sideways channel. Now when you see this type of a formation, this is an opportunity for you to make money. Now in the futures market, we don't care which direction the market goes. If it goes up, we buy and we go long and we make money. If it goes down, we sell and we go short and we make money. It doesn't matter which direction the market goes. So we just want to make sure that we're on the right side of the market when it begins to trend in that direction. One way to do that is to bracket with our narrow sideways channel tool a narrow sideways channel market. Once the market begins to go sideways like this, what we want to do is bracket the market, and I can reverse this just so that we get that text over on the other side. There we go. So now you see I got my text, price text, over on the other side. And as this market goes sideways, what we want to do is wait for a breakout, and then we're going to go in that direction. Well, a very simple way to do that in Track and Trade is come up here and hit the buy sell button. And if the market breaks outside of that trend line, we're going to buy one on a stop. So if the market goes long, we're going to go up. And very simply, just the opposite. If the market's going to go down, we're going to sell one on a stop. We don't care which direction the market's going to go. This is what's called bracketing the market. So if the market goes up, we'll buy. If it goes down, we'll go short. We'll just use the opposite order as our stop order. So our risk is the distance between where we'd get into the market and where we'd get out if we are wrong. What if the market comes down, fills our order, then turns around and comes up and hits our stop order? How much money would we be risking? We'd be risking the distance of that channel. In this example, that channel is about $890 wide. So by having our stops that far apart, if the market comes down, fills our position, turns around and goes back against us, goes up and hits our stop order, our stop loss order, then we would lose $890. Now, if the market continues to drop in our favor to a certain level, down to here, let's say the market comes down here, that's about a $3,000 profit with an $890 risk. If the market breaks out the top, and let's say it goes back up to this range here, this would be, again, about a $3,000 profit for an $890 loss. Now, what we do is we just wait for the market to move forward. We step the market forward. And, of course, we get a margin call, which indicates that I forgot to open up my account, so I make a deposit. We are in a time machine. Come back here, and we can come in and say $5,000. Hit OK. And you can see we sold one contract. So we're in the market short this very first day. We're up $42. And we've got our stop loss placed back behind the area of resistance, which is on the outside of the narrow channel. Now, as this market moves in our favor, we can then pull our stop in a little bit closer as it drops in our favor. So at this point, we can move our stop a little closer. And as this market moves in our favor down through the trend, out the bottom, you can see that we're profiting as the market moves, $817. Now I can move my stop in here a little bit closer and protect my position so I'm not taking quite as big a risk, which would lower this distance here all the way down. You can see I'm now only down around $190. So as we move that forward, that market continues in our favor, and we've brought our stop all the way down to our break-even point at this time. Now we just step the market forward, so if the market does come back against us, we'll get out at our break-even and we won't lose any money. It'll be a scratch trade. But now as the market moves down, 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 continues to go down, we can move our stop down just by simply clicking and dragging on it and taking it to new areas of support and resistance. Now what we've done is we can take our dollar calculator and we've actually locked in some profits, the distance between where we'd get out of the market if it came back against us and where we got in, which is $625. We've got an unrealized gain right now of $1,822, but we've got where the market pulled back, where we've locked in $625. So if the market pulled back against us, we would lock in and get out of the market with a $625 profit. As that market continues to move forward, we could continue to move our stops down, locking in additional profits. Now we're currently at $2,700, and of course you could call your broker and immediately liquidate that position and take your $2,700. Or you could just keep trailing down with a stop, and maybe the market will continue to drop in your favor. What we've done is we've locked in $1,535. So we step the market forward again, and as it keeps dropping further, we can tighten up our stops to lock in a little bit more profit. There's $2,255. Now the market's starting to come back against us a little bit. There we've got a signal from our stochastics indicator that this market is about ready to retrace and come back against us. Step forward again, and there it did. It continued higher, and we got out of the market as the market hit our stop. And so we got out with a $2,280 profit.